A very good afternoon and welcome all of you to this virtual roundtable for consultation on guidelines for appointment of statutory auditors of commercial banks, excluding RRBs, NBFCs, including HFCs and UCVs entities issued by RBI recently. As the pandemic has impacted a lot across all the sectors, so this is also one of the area which needs address on, and there are certain issues which are supposed to be discussed and deliberated today this meeting, and then we take it forward the manner which is appropriate. So let me introduce to all of you our council chairman, Mr. Shobhit Agarwal. He is the chairman of ASSOCHAM National Council for Internal Audit and Risk Management and the partner KPMG. And we have with us Mr. Kaushal Kishore for making a special presentation. He's partner from the SRN company. And for making a special comment today, we have a minute guest, Sri M. Narendra, ex-CMD, Indian Overseas Bank. We will be joined shortly by Mr. Raman Agarwal. He is Independent Director, Paisalo Digital. And we will be joined by Mr. Sunil Manucha, Founder and Director, CEO of Capital Squares. We will be with Mr. Harinderjeet Singh will be with us from PwC. We have requested Ashish Basil, partner EY. I hope he has joined. And Mr. Kamlesh Mittal, he's partner from Deloitte. And Mr. Khushru Panthaki, partner Wakachandiyok. Mr. Lalit Kumar is with us. I welcome you. Mr. Vishal Devadkar from BDO. And Mr. Yogesh Sharma, and many more people who have already joined here without taking much time. And I apologize for in case if I am unable to take your name individually. But I invite all of you personally and once again welcome and request Mr. Chairman to please take up the proceedings and then invite Mr. Kaushal Kishore to make the presentation and followed by the discussions on and around this subject, please. So over to you, Mr. Chairman, Shobhit Agarwal ji.
Thank you, Santoshji, and good afternoon, everyone. And thank you for agreeing to come on and in this huddle. I guess this has really been 14 months of real change, and we are seeing the government as well as the regulators keep pace with that. The latest regulation that came out on 27th of April, I guess, has a lot of far-reaching implications. I will not dwell deep into it. I'll obviously request Mr. Kishore, who's a senior partner at KPMG, to actually go through what the views are. And the idea of this discussion is, that we can try and deliberate over the period of the call on what obviously are the pros and cons. Let us keep the view of also the regulator in mind. It is not to say that this is a contrarian view or this is an alternative view, but what are really the implications that are coming out of this? And considering all the current circumstances, I most heartily welcome Mr. Narendra. Thank you so much, sir, for joining us. I'm sure we'll become far more richer from your conversation as well as your views, Mr. Agarwal, and the rest of the participants, my fellow colleagues from the other accounting firms, as well as of the various committee members. Without much ado, let me just hand it over to Mr. Kaushal Kishore for his views. And I would request, I did have a quick discussion with Kaushal, and he obviously mentioned that the idea and the objective of this would be far met if we really make this more deliberative. But Kaushal, over to you, and thank you so much for agreeing to do this or leading this discussion. And then for request to everyone that we have as rich a conversation so that whatever we are putting it up to either the regulator or to the government is well deliberated and is keeping with the times and being more pragmatic than more than anything else. Thank you. Kaushal, over to you, please. Thank you, sir.
Shobhit, thank you very much. Santosh, thank you for organizing this and having this opportunity for us. Good afternoon, everybody. The panel members, the committee members, Shobhit chairing it. Thank you so much for doing this. What I'm requesting, Santosh, is if you can just put the note also on the display, that will help, please.
And I would just like to add, sorry, Kaushal, before you start, thank you, Santoshji. I know you've not been keeping well. I'm sure a lot of people have gone through various personal strifes as we speak. and thank you again for joining in. I know Naresh was also my co-chairman was also not keeping well, and that's why he's excused himself. But again,
Thank you.
this is fantastic to see how people can come together for the greater cause and the better cause. Kaushalji, over to you.
Thank you. Thank you. Jatin, thank you for this. So I'll give you the context of this entire thing, and I hope you and your families are keeping well in such a time, and joining this session that will help us. We wanted to seek views from all of you who are the stakeholders, and we want to take forward the views of the regulator as well, because the real objective of the circular is not to put only regulation, but there is a lot of governance, there are a lot of quality initiatives which we certainly support, and we would like to support in any manner whatever we can do. So in that context, I'll take you through what we are looking for is what is the industry view on this, what are the views of the professionals, and then we go to RBI and request them to look at the views and make it more effective. We support them in terms of real implementation of the circular. So JK, if you can move to the next slide, that will help. So I'll give you an overview of the circular. What does it talk about? And also from the industry's perspective, we had a lot of discussions with people in the industry, and what kind of things they believe about it, and what kind of hardship or the governance process they will go through. We would like to see what is a balancing act. How do we make it more effective? How do we make it receptive to everybody, so that people are not just criticizing what has been done by the regulator, but supporting what is required to be done. There are a few clarifications which are required in the circular, and some of the next steps. We've done this huddle with SHM, and I think SHM has been absolutely fantastic in organizing such a short time. Circular has come at a short time. They have not given many days and the months and the weeks to for people to look at it, and before they apply, they could have planned it much better. But anyway, this is where we are. So JK, just move to the next one, please. The background of the circular is that it was released on 27th of April 2021. This has certain items which have a retrospective implication, and retrospective implication and this also goes to a lot of contracts which have already happened in the corporate law and the Companies Act, the auditors of companies and between NBFCs, etc. And therefore, this will have an implication going back to the previous year. We understand that there was no prior consultation. Today, if you look at the large regulators, whether they're Ministry of Corporate Affairs or the SEBI or Institute of Chartered Accountants of India, they have a very good practice of consulting people, issuing white papers and then talking about it, and then taking feedback from people, all the stakeholders, and then try and implement it. There is always a good amount of transitional period in which any regulation is applied, so it does not become applicable immediately. So unfortunately, what has happened in this case is that while the circular has been issued on 27th of April 2021, this has an application with the current year itself. So 2021-22 itself, the financials, the companies will have to apply it. The circular provides guidelines for appointment of statutory auditors of commercial banks and NBFCs. Largely, there are certain exceptions, but I'm not talking about it for the larger discussion and the ease of discussion here. Largely, it is applicable to the commercial banks. The background is that the Reserve Bank of India applied lots of audit regulations to the commercial banks always, and this was always in vogue. But non-banking finance companies, this is for the first time they are being applied, and they have come in the net of the circular. So I think the larger application is to the NBFCs. There are certain impact items so far as the commercial banks are concerned, and we will look at what these are. As I said, this is immediately effective for 2021-22 with no transitional provision. There's a very minor transitional provision which has been given for the NBFCs, saying that this may be made applicable from the second half because they're applying it for the first time. There are significant changes compared to the regulations which are currently in vogue, including coverage of NBFCs as we've talked about it. The extant regulations which were applicable to the banks for their audits and all kind of reporting to the RBI. A lot of things are being applied to NBFCs in that sense. The objective of the circular, as I said, that we are fully supportive of the objective of the circular, and I'm sure the RBI is doing the right things in terms of enhancing the audit quality. That is the objective. Independence, of course, is a major area, not just in India but globally. And there are several principles in the circular which talk about independence and the conflict of interest, where the auditors should be very careful around this, and we fully support all of that. The accountability of auditors, of course, because in terms of the independence, in terms of their connections with the groups and the companies and the kind of interest they have in the organization where they audit. There's a lot of accountability which has been placed on the auditors also. There is a lot of transparency in the selection process of auditors, and not just the selection process. Rather, at some of the places, for example, the companies will have to put it on the website. What was the process followed for selection of auditors by the companies? And there is whole amount of governance and monitoring process, including empowering auditors to escalate to RBI and to the company. And there are lots of things which have been done. Just to give you an example, the companies can go to RBI talking about the performance indicators of the auditors, how they behaved in their audits. So there are a lot of things in just to ensure that there is a quality in the process, and there's a whole lot of monitoring which can happen. There's a lot of management oversight and responsibility. Lots of things have been put on the onus is on the audit committees and the board of directors and the local management committees in terms of looking at the independence of the auditors, their performance, the process of the entire audit, and all kind of things which the auditors do in the milestone monitoring, etc. There is a good amount of onus on the management in that sense. So looking at the objective of the circular and the background of the circulars, absolutely this is I'm sure that the stakeholders are receptive to the requirements of what the RBI is looking at, and trying to support them implementable. JK, moving to the next one, please. Now, in terms of some of the broader areas in the circular, the applicability of the circular is that it's applicable to all the commercial banks and all the NBFCs which have a total assets of more than 1,000 crores of rupees. This is the exception of 1,000 crore is not applicable in case the NBFC is a deposit-taking NBFC. So all the deposit-taking NBFCs are covered by this circular. This is effective for the year 2021-22, and just to give you a flavor of what the applicability is, starting from the Q1, in case a limited review is to be done for a listed company which is in either NBFC or a commercial bank, the auditors need to be as per the new circular. And what does it mean? That if the auditors have completed 3 years, there need to be a new set of auditors. In case the banks or the finance NBFCs are more than 15,000 crore worth of assets, 15,000 crores worth of assets, in that case they require a joint audit as well, and that is the immediate applicability so far as the circular is concerned. The tenure has been reduced to 3 years for the audit of banks and NBFCs. It was always under the Companies Act. So the Companies Act, under the Companies Act, an NBFC auditor could have been appointed for a period of 5 years plus another 5 years period. So there's 2 blocks of 5 years you could have been appointed, but now it is restricted only to 3 years. And there is a cool-off period of 6 years compared to what the Companies Act cool-off period is 5 years is concerned. That's how there's a lot of restriction in terms of the tenure and the cool-off period is concerned. There is a significant limit on the audits. There is a cap on the audits. So one audit firm can carry out only audits of 4 commercial banks and 8 NBFCs, which was if I compare it in the next slide also, the earlier you would have done 8 commercial banks and unlimited number of NBFCs subject to the restrictions under the Companies Act, which is a 20 audits per partner. So there was a very broad overall limit under the Companies Act, and this is a very restricted limit of 8 NBFCs so far as the circular is concerned. There are very strict independence requirements in the circular. as compared to the Companies Act or the Institute's Code of Ethics, there are restrictions on the audit and non-audit work with the group also. And the group has been defined in a very, very restricted manner. These restrictions will apply during the tenure of the audit and 1 year prior and after appointment of the auditors. So largely what we are saying is that if you're appointed as an auditor of NBFC for 3 years, you are not in a position to carry out any audit or non-audit work 1 year before and 1 year after as well. So it's a total period of 5 years. There are restrictions on the audit and non-audit services with the group, and the group includes entities using the same brand name. So for example, if you are carrying out an audit of a finance company or an NBFC in a particular group, whether it is large groups, and most of the large groups, they have finance companies. Take any name, whether it is DLF or Tatas or Mahindras or any of that kind. There would be an NBFC within that group, and if you're auditors, in that case, you're not in a position to carry out the audits and non-audit work for a full period of 5 years with the rest of the entities who are using that kind of a brand name, whether it's Tatas, Mahindras, or HDFCs and large organizations like that. There are several other parameters, a large exposure of an existing audit to be reviewed by the board and the audit committee members. So multiple parameters have been instituted in this circular to evaluate the independence of the auditors, and that will help build, of course, the governance and the independence process in any case. There is a joint audit which has been made mandatory. So looking at today, the concept of the joint audit, so far as banks are concerned, in private sector banks, there are joint audits in any case because they are appointed by CAG, etc. But the joint audit is being made mandatory today with the circular for all the banks and NBFCs which has an asset size of 50,000 crores or more. NBFC did not have this kind of a requirement earlier in any case under the Companies Act. Yes, there is an enabling provision under the Companies Act that you can appoint joint auditors if the shareholders and the management so desire. But here it is a mandatory requirement. So certainly the limit of 15,000 crore is very low considering the sizes of the banks, commercial banks and the NBFCs we have in the country. There are many other requirements. For example, if the firms have common partners or under the same network of an auditor, they should be considered as one, which I believe, okay, I mean, there is no, I don't see there is any challenge so far as this part is concerned, because RBI certainly wants to look at the substance of the network and the partnership firms. If there are all common partners and if they are within a part of the same network, you can't misutilize the limits which have been given. So I think that should not be a major concern. The sharing and subcontracting of the audit is not permissible. Normally, it was not permissible earlier also, so it does not have a major impact in any case. JK, can we move to the next one, please? Whatever I spoke about, just a snapshot of at the cost of repetition, significant changes for banks, maximum 4 bank audits as compared to 8 earlier, 3 years term as compared to 4 years earlier, and mandatory joint audits with assets of 15,000 crore or more. So that is another additional imposition on this. So far as NBFCs are concerned, I think it's a major challenge so far as NBFCs are concerned, because all the NBFCs are coming within the net of this circular. You can carry out the audit of maximum of 8 NBFCs. Earlier, there was no limit except under the Companies Act, which was more to do with the size of the organization, number of partners, etc. There is a term of 3 years for NBFCs compared to 2 terms of 5 years. So actually an auditor or a company could have appointed auditors for 5 years plus 5 years, but today it's restricted to 3 years. And there is a mandatory joint audit. Auditors will have to be appointed by the companies if the asset size is more than 15,000 crore. There are significant other changes, as I said, that there is a restriction on audit and non-audit services covering the entire group, and I gave you some examples of the group and using the brand name. Independence evaluation covers 1 year before and after audit tenure. It means that the companies will not be able to avail the services of the auditors for non-audit purposes for a period of 5 years at least. There are significant changes in parameters for appointment of auditors in terms of number of partners, in terms of eligibility criteria. I think they're all good because the RBI wants to see the capability of the organizations and what kind of standing and experience they had in the past, and therefore those parameters are all, they should be good. There's a lot of onus on the board and audit committee and local management committees, as I said, in terms of the governance and the supervision process, which again looks like it's a good practice, so that people can be responsible and they are accountable for the entire thing. Okay, if you move to the next one, please. Now, looking at the industry's perspective, it's really important from the industry's point of view how to apply this, make this successful, make it effective, and reach the objective of what RBI wants to achieve. There is unfortunately, the way it has been done because of an abrupt issue or release of a circular, which has far-reaching impact. But looking at the kind of time we are in, just to look at the applicability of the circular in the first case is the paucity of time to implement. The requirement to appoint in the upcoming board meeting. So, for example, if a listed organization, which is whether a bank or an NBFC, if they are having their board meetings for the March 2021 financial statements, and normally what happens is that the auditors are appointed or proposed in those board meetings only, so that they continue to be so that they can appoint in the AGMs. In any case, the appointment could have happened for 5 years as per the Companies Act terms, because the Companies Act allows you to do, rather requires you to do, a 5 years appointment instead of every year's appointment. So all those auditors which have already been appointed and the 5-year terms have not been completed, they require a fresh process immediately for the quarter or at the end of the quarter, so that the new auditors can take over and carry out the audits. The only exception is that the NBFC can do it in the second half instead of the first half. But unfortunately, what will happen is that if the auditors have carried out the audit in the first quarter and the second quarter, and if you appoint another auditor in the second half, it's a major disruption. The auditors appointed in the second half will have to carry out the work again, and they'll have to review everything again and get familiarized to carry out the year-end work in the third and fourth quarter. So I think it's a major challenge so far as the appointment of auditors in the first half or the second half, in any case, is concerned, whether it's bank or the NBFC. There is a very lengthy process, because in some of the cases which requires a joint audit, the companies will have to look for joint auditors. Unfortunately, looking at the eligibility criteria, there would be a major challenge in terms of the capacity as well, because there may be, for example, if an audit of a company which has an asset side of more than 15,000 crores is concerned, they will require a joint auditor with an experience of 15 years of standing in the firm. Unfortunately, there is a possibility that you do not find such auditors immediately, and it's a long process for the management and the board, etc. And they'll have to redo the process, which was already completed for the past auditors, which was done in the last 2 or 3 years. There is no doubt that there are challenges thrown by COVID-19, and people are working offline, and that again is a specific criteria. I'm not sure RBI could think about it, but it's a major challenge identifying the auditors of the size, skills, nature, etc., which are relevant for the organization. Joint audits, there are both the views possible. Joint audits may add value, may not add value. But if you look at the global practices, there is no empirical evidence on improvement in audit quality globally by the joint audits. And unfortunately, in India, what happens is that the auditors divide the work. They don't take responsibility of the joint auditors' work, and they are responsible only for their own work, as they write in their audit report as well. So frankly, if you see that the audit quality is improved, the answer is that there is no such precedence available or an evidence available that the joint audit increases the audit quality. It certainly increases the cost, because there are 2 auditors. There is a duplication of work because there are a number of areas which are duplicated. And is there a supervision of the work of the other auditor? The answer is no. Reason being that the India allows not to supervise the work of the other auditor, and they are responsible for their respective work. So I think on 3 accounts: one is the cost consideration, the duplication of work and inefficiency involved, and of course coupled with the past precedents that it does not add value. I think the RBI could have considered that joint audits are not mandatory, and they allow this and they leave it to the management and the audit committees and the shareholders. If the joint auditors are required, and if they believe that this is necessary, they can always apply this, because the Companies Act has an enabling provision of joint audit. not required to be imposed. The choice will be restricted, of course. The companies will have to see the eligible firms based on the size, scale, experience, and their reach, because there are large commercial banks and large NBFCs which require the kind of experience the large companies would need. And there are stricter eligibility requirements, including the cap on audits and the cool-off periods also. Because of that, there would be a lot of auditors. They may not be eligible, and the companies may find it very difficult to find auditors of the same scale. The groups, and this is a major challenge. The last point says that if you're deploying multiple firms, because as per the circular, if you're auditors to a bank or an NBFC in a particular group, you're not in a position to carry out audits and non-audit services for the rest of the companies. Unfortunately, this is creating a major problem. So the management will find it very, very difficult to identify the audit firms which can handle the kind of size of these companies are. And at consolidation level, because there are large groups, they require consolidation at the top level, and you will face multiple auditors in that sense. And they will not have any oversight on the rest of the companies or the group transactions, and the consolidation will become very, very ununiform from that point of view. So this will certainly pose additional challenges due to the eligibility conditions and the kind of restrictions the circular has posed. JK, if you move to the 7th one, please. The group audits and complications, as I said, and I'm repeating this, the group auditors may not be responsible for the kind of work they do, and the rest of the auditors they will be relying on. There is another implication. Now, if you look at one set of auditors are carrying out the audits of banks and the NBFCs, and there are this circular poses a lot of restrictions on the rest of the companies which are not regulated by RBI. So if you're auditor to the bank or NBFC in a group, and there are other manufacturing and other service organizations within the group, this circular is imposing restrictions on the auditors of companies as well, while they are not governed by RBI. So unfortunately, there are some far-reaching implications of this circular because of the kind of restrictions which have been posed for the NBFC and the bank audits. The subsidiaries of global companies may face a lot of challenges due to multiple auditors, because there are group reporting requirements. There would be a lot of duplications as far as this work is concerned, and in consolidation there would be a lot of inefficiencies so far as these kind of companies are concerned. Looking at the value from audit, if there are multiple sets of auditors and they are moving every 3 years, then the management is hunting for the auditors every 3 years. So unfortunately, the management is not in a position to have benefits of the cumulative knowledge and the experience these guys earn over a period of time. If you look at, there was a very reasonable period, continues to be a very reasonable period under the corporate law and the Companies Act, that the auditors are appointed for 5 years and they can be renewed for another 5 years. So I think there is a good amount of knowledge and experience gained during those 5 years, and then there is a cool-off of 5 years. But in this case, what is happening is that if the tenure is 3 years and the cool-off period is 6 years, basically the companies will be looking for 6 sets of auditors in case joint audits are required. 2 sets of auditors every 3 years. So unfortunately, it becomes a very, very ineffective or efficient exercise. Auditors also, it looks like that they would not be willing to invest in the skills and technology due to the short tenure, because every 3 years they need to rotate out. So what kind of understanding they gain from a particular organization, whether it's bank or NBFC, every 3 years they have to rotate out what kind of technology they will develop for a particular client. So I think that's a major challenge in terms of the capacity building and the skill building. This certainly has an impact on ease of doing business, because there is a constant hunt for auditors. There are unproductive efforts on orientation about business and the risks and the systems, process and controls at very frequent intervals to different and unfamiliar firms. And at some point in time, I'm sure that the managements will become very indifferent so audit process is concerned, because it becomes a tick box exercise concerned. There is an increased effort in multiple auditors for the group, and in a consolidation, this entire coordination, because they will not have any oversight on the common transaction, the common group entities, and the kind of interfirm transactions they have. So there is a possibility that the global firms, they find it an impact on the valuation of the capital inflows as well. While it's an indirect one, but yes, there is an important one. JK, if you can move to the next one, please. Thank you. This is very important that we are looking at inconsistent regulatory principles. So Companies Act has certain principles on everything, whether it is an appointment of auditors, the tenure and cool-off period, the joint audits, the non-audit services, and the related parties. All of them are very well defined. They've been working very well so far as the Companies Act concerned. There are no global practices which put so many restrictions on the banking and financial services sector. This is very unprecedented the way it has been done so far as the Indian companies are concerned, and Indian companies will have to go for this kind of an audit process every 3 years. This is also unprecedented. We have a set of principles under the Companies Act and the Code of Ethics. They're together. And if you look at the Code of Ethics of the Institute of Chartered Accountants of India, is very much aligned under the international principles. So there are good practices which are already on, and I'm sure that by tweaking some of those practices, but without restricting too much, we can still achieve the objective, and that is the request to RBI which we'll be making. Yes, JK, please. What is that we are asking for? What we are looking from RBI or the regulator is, excuse me, please review the extended coverage to the NBFCs. Banks are already covered. There is literally no need, we believe, to cover the NBFCs, because there is a term of 5 years and you can always rotate out after 5 years. Small size and medium size NBFCs will find it really difficult to keep hunting for the auditors in that. So I think the RBI may consider looking at the applicability only to larger NBFCs. So for example, they can identify a trigger of 15,000 crore asset size or more than that, and then they can say that this is what is covered by the circular. So that is the first request to RBI possibly we would like to do. There has to be an adequate time, because you can't apply a major change in the policies retrospectively. So all the independence principles in the cool-off period, which is 1 year before and 1 year after it becomes applicable today, it's a disastrous situation. I'm not sure that the companies would be able to comply with that, because there is no way you can comply with this. So transitional provisions certainly require, one is a phase-wise implementation, and phase-wise implementation has been very, very successful in many areas. The applicability of Ind AS, for example, like the applicability of accounting standard, applicability of many other items which are large ticket items in any policy making. There is a phase-wise implementation and which can work really well. So the RBI can identify that in the first year it is applicable only to those companies which are 15,000 crores or more asset size kind of thing. In any case, they need to provide it implementation period of at least 2 years, because the implications of the circular which are going backwards, they certainly require a minimum time period of 2 years at least. There are severe restrictions on eligibility, including cap on number of audits that will restrict the capacity. First of all, the companies will not find the right size and the level of auditors, and they will keep hunting for the auditors because of the cool-off period and the tenure, the size of the tenure. So this has to be aligned with the Companies Act. So I'm not sure RBI, what is the RBI's objective so far as that part is concerned, because creating a diversity between the Companies Act, Code of Ethics, and then RBI circular on the top of it, the compliance becomes a very expensive exercise, and it doesn't. I'm not sure whether it serves any purpose in terms of governance of the audit quality. The applicability of joint audit should be looked at, and I'm sure that they can identify a limit, which is 15,000 crores and above. See, push comes to shove if they say that this has to be applied to these companies, but nothing beyond that. Align the restrictions of services. There is no need to say that the non-audit and audit services are restricted for the group entities, and that too including the brand name, the companies using the same brand name, because it does not serve any purpose so far as the independence and the quality is concerned. The Companies Act and the Institute's Code of Ethics, they are all aligned to the international practices, and I'm sure that they really work well without any additional restrictions around that. And I'm sure it's a good practice to seek inputs from various stakeholders and some of these challenges which industry will face. And I'm sure that the board of directors and the audit committees, they'll have larger challenges in terms of identifying the auditors. So I'm sure RBI should look at the recommendations and then see what is practically implementable and not. JK, if we can move to the next one, please. There are a couple of matters for clarification because of the drafting issues in the circular. Applicability of the circular to various types of NBFCs. And I'm not sure whether it is an intended application. Now, there are many NBFCs which are not intended to be NBFCs. They don't have any borrowing, so they don't have any lending like that. They are pure investment companies. So from that point of view, applying this circular will be a far-fetched exercise. Such as there are core investment companies, the broking companies, the insurance companies, the asset management companies, or these reconstruction companies. I don't think they have an objective the way RBI is trying to regulate. So there is a big clarification which is required why to cover all these companies which are not intended to be NBFCs. The board and audit committee's role on anything which is to enhance the governance process. But while there are a lot of principles in this, there is no process which has been provided. So I think it's important that RBI provides a process also. How would a particular item be implemented practically? So there are a number of items around that. The impact of audit of tenure for existing NBFCs crossing the threshold of 1,000 crore. So once after the appointment, if they break the threshold, what happens to that tenure? So I think there are a lot of clarity required in that area. The audit of entities which have large exposure to banks and NBFCs. So there is a particular provision which says that the management has to review a large exposure to the bank or NBFC, and if the auditor is auditing another company which has this exposure. So this has an impact on the independence of the auditors and the management as well. There's no process which has been given, but unfortunately, if I look at the nitty-gritty, there is a very long exercise, and it's a very important exercise from that point of view. There is no clarity on the internal and special assignments and the regular process for the approval of that, because the circular says that any non-audit services have to be approved by the entity's audit committee, or the board has to take a call on that. So how will it work in respect of the company as well as for the companies in the group? So unfortunately, if the NBFC's board starts taking a decision on the non-audit services being provided to a group company which has nothing to do with the NBFC, frankly, it's only using the brand name, that may be a little far-reaching consequence from that point of view. So I think there are a lot of clarification. I thought, let me just try and summarize 4 or 5 of them which are more important in this sense. Okay, so I think that was all I had. JK, if you move to the next one, please. This has been a monologue because of the virtual sessions like this. So we'll be looking at the questions and the inputs now. What we believe that as ASSOCHAM and the committees, we are trying to work on the inputs if we can receive from the stakeholders, and ASSOCHAM will work on a draft representation by 22nd of May with some kind of a 2 days timeline for review and finalization. And I'm sure ASSOCHAM is looking for a representation to the RBI and additionally to the Ministry of Corporate Affairs early next week. So that is the plan we have. And I'm sure that is achievable considering the importance of the circular, the kind of requirements and the implementation timeline we have, which is immediate. All the board meetings are happening, and I'm sure that they'll be followed by all the AGMs. So the companies have to organize for the auditors and look for the auditors and joint auditors as well in case something is applicable. So I think these are some of the next steps which I thought are relevant to convey. JK, the next one, please. Yeah, so that was all I had. Apologies that it was a monologue at the moment because of this kind of a process, but more than happy that people have their questions or the clarifications or any inputs around that, and I'm handing it over to Shobhit and Santosh to just organize how do you go about the questions and answers.
Thanks, Kaushal. Santoshji, if you'd allow me, I know you've been asked to talk less over the phone. So if you'd allow me, I'll just try and moderate and please add in wherever. So may I just request, we've obviously heard Kaushal talk about and take us an overview. May I, request Mr. Narendra if he would like to add in any viewpoints to start with, and then obviously keep inviting. And if there are any questions, interjections, please feel free if you can raise your hand or come in as and when you want. Thank you. Mr. Narendra, over to you, sir.
Thank you for Santosh and SOHM, particularly chairman and other vice chairman, and all of you having invited me for this particular very relevant and very pertinent subject. And we had a very, means very exhaustive and comprehensive review by Kaushal Kishorji.
Thank you.
And with the background of that, and actually congratulations also, with that background, we have very limited point to talk. But that since it is a debate and you are also looking at some points for consideration for taking to the Reserve Bank, it is ideal that we all discuss that. And of course, from the banking and NBFC, as well as there may be a lot of what you call statutory auditor or the auditors also in this committee. So for the sake of all stakeholders, this matter is being taken up. However, of course, as Kaushal said, normally very important what you call regulatory guidelines, they send the paper for prior consultation or prior feedback, and then they finalize. Now I understand, Kaushalji, that in this particular case, there were not much that consultation.
Right.
Because maybe that informally they would have had any Institute of Chartered Accountants or any other level, whether they had, that is not known. Because normally I think Reserve Bank and the for the bank like CAG and Department of Banking and Finance, DFS, as well as our Institute of Chartered Accountants, all of them in the Basel, what you call in that index and all, they were all a part of the committee, and they, after due discussion, that necessary guidelines have been brought. And having auditors are very important part of the stakeholder. There would have been had, or I'm not sure, that would have helped. And of course, one thing is Reserve Bank is going to bring most of the guidelines uniformly to all the regulated institution dealing with the public money. In a way, if you see quite a lot of these recent circulars and all coming, all lending institution or like that. So here also it is all the commercial banks and NBFC, as well as the maybe urban cooperative bank, except maybe RRB. Other things are all included. So as you go forward, we are all and housing finance also. So we are supposed to, because now that is why the housing finance also for regulatory purpose, it has been brought within the control of RBI. So it is sometimes the flexibility or leverage which other organization may be enjoying, because there is that may go, like even now there is another paper from the RBI that depending on the level of NBFC, there will be a differentiation in what you call supervision and control, and that has been put for feedback. So that is the one which is also been done here. And as far as of course the public sector bank, we are to get a list of auditors from the CAG, which comes to RBI, and RBI again goes through that and see some of their major eligibility and other things, and the final list comes to the bank, and the bank also will have to see the within their whatever internal guidelines as well as the RBI guidelines. And once that is seen, immediately because these are all done very quickly, and they take it to the audit committee, and the audit committee approves that, and best of the such auditors used to be selected. I myself was in charge of the financial management department in my earlier corporation bank, and of course in both the Bank of India and IOB, we had that very excellent what you call firms doing the audit, and the joint audit is already there in the public sector bank. So as far as that is concerned, it is not new to the PSP. But as he rightly said that for NBFC and all, they were flexibility with the same one firm for maybe a period of 5 years, what he was mentioning. And today the uniformity in the public sector bank also, it was 4 years. Now it has been brought down to uniformity of 3 years. And for the asset size above 15,000, as I understand that today, the NBFC having that type of size, number may be limited, and it is ideal that because that joint audit has to be there. Otherwise, it was the privilege of some of the leading top chartered accountant firms or consult or what you call big firms, and they had that for a longevity also. So there are merits and demerits, both the sides. In a same way that once they are continuing with the 5 years, the regulator would have felt that it may not be the ideal thing to continue for that longer period. So that they have for PSB also, instead of 4, now 3, here also 3, that they have done. And the intervals of cooling period, I think कौशल जी बताने का, ये 6 साल का था, मालूम नहीं है मेरे लिए, ये थोड़ा long I think. वो उनको 6 साल का
the banks had a period of 6 years already, but NBFC had a 5 years period.
5 years. So there now that 6 has been made applicable here. That was the best practice. So that has been made here. And one thing I was, Saushal was saying that the NBFC and all, whether we'll get that type of good firms. So there may be opportunity for, because I think by formal or informal, we find some of the audit firms getting what you call merged or whatever, having understanding. So you may find some of the audit firms, if they are very small in size, or whether size in the sense, or the number of qualifying auditors in the firm may not be there. There may be opportunity for them to come together with the this opportunity of getting the audit of NBFC or Urban Cooperative Bank and Housing Finance Institution. And from the public shareholder point of view or the investors point of view, it has been now little no concern that with the continuous economy going in a problem and some of the big NBFC getting into difficulties, and all of you are aware of those cases. So it would have come to the knowledge of the Reserve Bank that they are also ensure some type of what you call audit effectiveness and the audit efficiency, and also audit help when they also regulate, that they get a comfort from that. So the regulator would have thought it is ideal that for all that NBFC above 15,000 crores, because as you go bigger and bigger size, it is all called as a, there may be a systemic impact, and that systemic impact was visible in 2 of the major failures. It has been a very major failure and it had an impact. So similarly, of course, in the private sector bank also, you would have found that there are 1 or 2 major failure, and that has shaken the confidence of the regulator, confidence of the investors, and investors has to suffer a lot by way of complete changeover and all of the management, and all of them who have invested, including I think perpetual bond, all that, they lost the money, including equity holders. So now in that connection, they have to bring this type of guideline to the private sector bank also. Now the one area that the private sector bank also had no joint audit and all, I think कौशल जी वो भी private sector bank को नहीं था, अभी इसमें उनको भी that joint audit has come, and they may have to have a minimum of 2 firms. I think that is really in a way, I feel that because I have seen when the number of audit firms are larger, you have, for people like us who are heading that department and all, no, you have a very tough time, and you need to coordinate between the firms, and we normally have a lot of consultation meetings, and we even about allocation of large or extra large branches, that is minimum 20% of the branches or that advances are to be audited, and with the minimum of 20 branch. So you have a lot of work to be done, and sometimes you go into such a criticality that the department head or the various of our senior functionaries, they are also put into like difficulty, not in relation to the following the guideline or not. There may be some point of view differences and all that. So, but I have seen the auditors themselves also will have exclusive meeting within themselves and broadly arrive at certain parameters or best practices, and they were able to do the audit work in a very perfect and timely manner. And quite a lot of the public sector bank also now, including maybe private sector bank, they have been completing the quarterly or the statutory audit all in time, and within the maximum 28-30 days, the results are out, even in the statutory audit. So in that way, when you have a joint audit and little higher number, maybe 2 numbers of for the NBFC and all, that will also help in having the distributed work and the specialization also. One firm may not, of course, be leaving the besides of big firms or big leading firms. There may not be have the everybody auditors will not have the specialization in critical area like the advanced risk management or even treasury management or the Basel requirements or capital planning. There are quite a lot of now specialization is there, which needs a specialized area of experience. That is where I think that minimum 15 years of experience by the auditor, and who would have audited so many such corporate and as well as the financial institution and all. So they are in the right eligibility. So I find, and these are all in a way, because of the time, I do not wish to take much of your time. And but one thing is now for the other NBFC and all of them, that there is no what you call other audit by the branch auditors, whereas the public sector bank now, even by minimum whatever is mentioned up to 6 or 8 or 12, there is a maximum. So within that, depending on the size and all, the audit committee and the board is empowered to take a call on what is the number. But our branch audit, we have to complete all the other branch audit of critical branches, and all these branch auditors will have to be coordinated. And before this audit schedule for the statutory auditors, that have to come, then the zonal audit or other critical functional audit and all that. So there the process of audit is very, very comprehensive and very lot of coverage. Now this concept has not been made available for NBFC or other housing finance company. So it is at the corporate level only, and the percentage of, yeah, of course, some branches will have to be visited. That is also there, 100 branches and all, I think. Other than that, you need not have any sub-auditors or others. So that is not made applicable. So I think, of course, below 1,000 crores, the option is with the, what you call that company NBFC itself. And the annual performance review, renewal and what reappointment, this even in the public sector bank, even though the term of 5 years is given or what 4 years is given, we would always make a realistic assessment, and such cases are very minimal. And if the divergence is found, suppose in any of the audit later, the Reserve Bank finds substantial divergence, that is also a matter not only for the bank and this is for the auditor also. And sometimes the Reserve Bank will call the auditors also for a discussion, and some of them may get a necessary notice or letter. So that is being the case. We need to really those divergence, I think, over a period of time with the offline inspection also and the online inspection of the RBI, as well as by the banks following all the laid down guidelines, and that has been coming down. So the statutory auditor review renewal and see whether they are what type of course, some of the aspect may be even in terms of their cooperation or in terms of their involvement or even in terms of their what you call efficiency or that much which is there in the biodata, whether it is reflected or not, and the quality of audit. All these aspects are being taken by the bank, and generally we have not found much cases where they may be denied for after that what you call yearly performance review. So that is today our as we said, our Institute of Chartered Accountants as well as most of the auditors have risen up to the occasion, and their quality is good. So with this, I think I will of course that making available this limit that even for the current financial year itself, and that is of the urgency. Maybe I don't know what exactly the because there may be this point, maybe the SOCM you are taking, maybe that they may give some more time, because the COVID is also continuing, and auditors are also learning how to do the audit during the COVID. And as quite a lot of our bank, like, just now I was talking to one of the leading public sector bank. So my colleague there, he mentioned around 50-60% of his staff who are in the audit department, they are all affected by COVID. Now, how they will be able to give the necessary data to the auditor? And also, this being the case, there may be a case for giving some more time, and some of the critical area, Kaushalji, Matayata, that there may be definitely chance. And if you are feeling, of course, we don't really say that our branches should not be audited, but whether there can be also some guidelines, it is there. Those branch auditors also, some of them are sometimes bring lot of hindrance. So it is whether known or unknown, or it is formal or informal. So those things also have gone now, but there can be some more aspect of control on the branch auditors, so that the statutory auditor also will be able to get the full cooperation from them, and the long form audit will get proper reflection of the internal financial control and other risk aspect, and that will be used as a tool for the bank to improve. So overall, sir, ये NBFC में ये सब अभी long form audits अभी आया नहीं होगा. हाउसिंग फाइनेंस कंपनी में ऑडिटर रिपोर्ट रहेगा, बट इधर तो banks are having a very good tool of long form audit. That is also very good. And Reserve Bank invariably, when they come for inspection, they go through that. Other than the stock audit report, credit report, there are quite a lot of tools which are available, which gives the statutory auditor also a pulse of the bank. So it is necessary that individual NBFC and other things, they also may be having their audit policy and compliance policy and risk management policy. And the Reserve Bank has come with the guideline for all of them, that they should have a separate chief risk officer, they should have a separate chief compliance officer, and they should have a separate internal auditor, means you are a control auditor. With that, their lines are very directly to the audit committee or such concerned committee, and also maybe overall supervision by the CEO. So this methodology, all that will ensure better reporting, better compliance, and better audit report to the stakeholders. Thank you, sir.
Thank you, Mr. Narendra. Thank you, sir, for the detailed conversation and obviously your views. I'll hold back. I have some questions and some pointers. But Santoshji, you had mentioned Mr. Raman Agarwalji might be needing to move on and take some other engagement that he had. Is he still in the call? I'm not sure.
I think he has moved out, sir, because he has certain other engagement. So
he has.
yeah,
Okay. Okay. Before I just request comments from any other of the other members, and also Sunilji to and others to add in. So just a couple of questions to you. You've obviously been at the on the other side of the table, if I may call it. It's a round table, but still stakeholders are important. Like you mentioned on joint audit, and I've seen some of the comments that are coming through. I think Kaushal raised a very important point, which was the idea of joint audit is obviously good because you can divide between two auditors. You can take the benefit of specialization of the two auditors. Everyone is not great at everything. They specialize in certain things. So but has there been, and I saw one more viewpoint saying that, because the West has not taken it up, does it mean that we don't take it up? I agree. I'm not denying that. But the moot point is, does joint audit, and have you as a client or been a client and the chairman of the bank, have you found the joint audit improves the quality of the audit and what you get as a feedback? Because it's your feedback as a stakeholder, which is really important. If you say that, yes, this has really improved the quality of the observations, it's definitely a step in the right direction. Just to also let the audience know, I visit the Gulf quite a lot, and the largest country in the Gulf, which is Saudi Arabia, the central bank mandates that every bank has to have a joint audit. right? So it's not that countries don't adopt. I'm sure India is not the only one. But sir, back to the question for you: do you feel that the joint audit has improved the quality of the audit? Because, like Kaushan said, auditors will divide their scope and they will not touch each other. And I have started my training as an auditor. I feel it's very, very important to get an overall view of the entire audit rather than just be limited to certain area. So, sir, sorry for the long question, but over to you. And to everyone else.
Shobhit ji, I fully endorse joint audit from the point of that requirement, which will be very useful to the bank. So normally for statutory auditor, we normally don't look only that completion of the audit and giving the completion that within the time schedule and all that. We look for their total some online or what you call offline or online also in a way. Quite a lot of inputs also. Now, with the some of the statutory auditor may be very good and excellent in the information technology or the in relation to cyber security or the new things coming in the as far as these areas of specialization. So I have a case where one of the such statutory auditors studied our entire technology not in my current this one in another bank, and they gave these inputs which are not part of the audit our guideline also. Even in the bank where I was there were continuously those inputs which are not part of the audit also, but that input were monitored every quarterly, and every action taken were what you call assessed how much and all. So similarly, now another important area is integrated treasury. Now, when you have seen some of the one big problem came in one of the public sector banks. So some of the auditors are expert and they may able to quickly get a feel of that what is the overall strongness or the robustness of the integrated treasury and how the mid office is working, and whether there is a total independency in these front, mid, and back office, and such an they give the or where commodities traded, or there are other forex hedging and all that. Some of the complex product, whether in a way that understanding and giving on derivatives and all that. So there are leaving some of the big firms, then some of the firms may not have. So they will complement each other. The joint audit will complement each other. So then, as you are mentioning, when they get the report also, even though the work aspect has been properly allocated, when it comes to the finalization of accounts, all the 5 firms, 6 firms are totally sitting together and then arriving at the risk aspect. What are the gaps and what is that? And finally seeking the management views, where are you could fill up and where are the thing. And then once I have seen so many times during the process of audit, the entire auditors meet independently in a boardroom and arrive at certain strategic plans. And some of the challenges are also given to the management, or so that they come up to the expectation, or they will be able to challenge it in a correct way. And these are all this is good actually. When that is where I mentioned Shobhit, when it is a today all NBFC or housing finance are all working not like it is a one individual promoted company. They are the doing business with the public good and public money, or even they may take public money deposit, or they may have their own shareholders or others, or if they are listed, definitely it is a higher responsibility from the other regulator also, SEBI and all. So that even from the interest of the management itself, or the promoter, or what you call now person in control as per the latest, and the stakeholders interest, it is ideally that a very complementary joint auditor, in a way they have a good opportunity to select, because for these which are those, they would have made some exercise to see which can be the complementing auditor, who could be the second auditor when they have to do the joint audit. And if that is comes, and most of these professional people, they are already well in touch and they know each other and they take the help of each of that compartmentalization is not really there. So maybe as you rightly said, global itself is already there. 1 minute, sorry. Globally, it is already there, means it is a very thing we should adapt, and it should come to India. And Reserve Bank timely, at the appropriate, relevant, critical time now, they have brought this concept, and most of the NBFCs have matured now. Once they have matured, to adapt a best practice should not be difficult. Thank you, sir.
Thank you, sir. Thank you for your views. Like I had noted, you strongly endorse joint audits and
Yes.
what are the benefits of those. I know, Mr. Chitle, you have been raising your hand, sir, for a long time. Please add in. I'm sorry, I tried to send you a message. I'm not sure whether you received it, but please add in, please. And Kaushal, I'll come to you. I know your hand is up there. Please.
Sure.
Sorry.
Thank you.
Thanks a lot. I think ASSOCHAM has very rightly organized a program or a subject which is called Dear to the Industry and Auditors. So I think first is congratulations. I had not known this earlier, so I had not prepared a detailed note, but a quick response on whatever was heard just now. I think the initial presentation was excellent, good, pointed, very good. Now let us look at some fundamental aspects of what is pointed out. So I'll go more on the concepts than on the details. I think a few clarifications are required, that is obvious. The mention was made about housing finance companies. I think presently those are monitored by National Housing Bank. Maybe this would to some extent give a leeway also to Reserve Bank of India to do the necessary work. But that's an NHB being a subsidiary of RBI, I think it's in the same direction. So that is one point. Main subject was mentioned about joint audit experience and how people do it. I think a few minutes on that. The institute has got a program, a detailed statement on the subject, and the insurance companies and public sector banks have been dealing with it. Fortunately, I have had the experience of handling those kind of joint audits at various levels, including up to Reserve Bank of India. While each firm takes the area of work that is allocated to them, the responsibility for opinion is common to all. So the true and fair view is expressed by all of them. And if somebody holds a different view, he is absolutely at freedom to express a different point of view. So it is mandatory, it is necessary for every firm to take a final view of the matter. So it may not be appropriate to say that one does not take the responsibility for the final opinion. I think in the past, there have been cases, even in public sector bank, where one firm had expressed a different opinion. I won't take names for the sake of convenience, whereas 4 other firms had expressed one kind of an opinion. So I think in case of joint audit, let's be very clear that the institute's statement at the moment is very, very specific on all these subjects. It identifies how they will process the matter, how they will exchange the ideas between them. But ultimately on a balance sheet, I think the opinion is considered to be, and legally also, a common opinion. If somebody holds a different opinion, he is free to do that. I think that is as far as the word joint audit is concerned. Secondly, sometimes if something is not started in foreign countries, let's not worry about it. If we believe that as a country, we find it to be a good practice and we feel it is something good, let other countries pick up from us. Let's not worry about whether other countries are doing it or not. And I think, Shobhit, you rightly pointed out at some place that this is done at few places. So I think that's as far as that subject is concerned. One more mention was made about one firm reviewing the work of other audit firms, etc., etc. I think that was in the presentation, and therefore let me touch upon it. This aspect was also noticed by SEBI about 2 years ago, and SEBI had formed a small group. And thereafter, SEBI came out with a circular which clearly states the procedure to be followed in such cases. And the distinction arises because the auditing standard in this respect outside India, in a way you can say international standard, is not exactly adopted in India. India, the conditions of the institute are saying very clearly that each individual firm is responsible for its own opinion, and therefore it is possible that the holding company audit is done by A, but subsidiaries are by B and C, etc. Now that was the issue which was raised at the SEBI for all listed companies. The SEBI formulated a committee, the committee gave its views, the board considered, and they came out with a circular which clearly states what kind of directions can be given by the main auditor to the auditors of subsidiary companies, which also arises from the standard laid down by the institute, and that is being implemented by all the auditors of listed companies in the last few years. So I think conceptually, as far as these two concepts are concerned about the joint audit and one firm reviewing the other auditor, that is something which is prevailing in the country properly. And lastly, just again, point of concept, when we say NBFCs, the source of funds are ultimately through the bank, through the insurance company, it's the public money. So somewhere the regulator must have thought it appropriate to monitor it in an appropriate fashion. Now, there can be always different views of saying how it should be monitored, but the fact that it needs to be monitored is certainly in the interest of all of us, because end of it, all of us who are representing ourselves as professionals or industry people are also citizens of this country, and we are contributing our small mite to the deposits of the banks. So if that money is going to NBFC, it might be appropriate for the regulator to look at the subject. Maybe there can be two approaches, there can be two views about how to deal with this. But I think, let me end up, because this is not a speech, so let me end up by saying that congratulate ASSOCHAM for doing this. If we are thinking that the ASSOCHAM should represent on this matter, I think an overall point of view is required. Only one point of view may not be appropriate, and national interest should always be uppermost in the minds, which of course I'm sure all of us who are attending have that interest in mind. Thank you very much.
Thank you, Mr. Chidle. May I just request, Kaushal, you have your hand up to add in. I would also request the other members as part of this conversation to please just put your hand up. I have a record who's wanting to speak, and I can just request you directly rather than, and in case there's any comments in the chat window, I will obviously request Mr. Aki, I'll come to you after this as well.
Thank you, Shobhit. And I think it's been a very experienced people like Mukunji. Thank you very much for providing your views. It's very clear. Narenji, so nice of you to talk about, and all of them had very, very useful comments. I've seen the chat box as well. I think our objective would not be served if we talk only about joint audits, and I fully agree with most of these comments which have been made that the joint audit and possibly joint audit is not the main concern here. Joint audits has been made mandatory only for NBFCs and banks which are more than 15,000 crore worth of assets. I'm not sure there are many of them. And PSBs are already under joint audit. So I do not think that I'm raising a concern only on the joint audit. I think at the cost of repetition, and Mukunji, you've talked about it, joint audit, a number of times. A lot of people have expressed a lot of things very strongly about joint audit. I am absolutely, for the purpose of, looking at the kind of experience, the kind of comments which have been made, and they're very valid comments on the joint audit. My concern would be that a circular which becomes applicable for 21-22, I think it requires a significant amount of time in terms of implementation. There is no doubt around that. Even identifying a joint auditor in the first quarter and second quarter would be a challenge. So I'm sure that the industry and the professional, friends, they are of the same view that we require some time for the industry at least to look at the right size and the kind of auditors they have. The second thing, as has been rightly pointed out, that the NBFCs, whether this is the source of money which is coming in is the same. Yes, you're absolutely right. And there may be some kind of a supervision which is required, absolutely fine with that. But I think covering all the NBFCs in one go, and I'll give you an example. There are a lot of investment companies which are not intended to be NBFCs. They don't have borrowings and the lendings. They are only investment companies because of the parameters given that the profit or the revenues are 50% of their overall revenues, and the asset is 50% from those assets, and that's why they become NBFCs. Well, this is not the intention of the organization. Sometimes they may not even require a registration with the RBI. So applying all these principles to those kind of NBFCs which are not intended to be in that fashion, maybe that it's a far-fetched exercise, and maybe that it's a phased, as I said in my presentation also, it's a phased implementation. Phased implementation has not been a bad idea in the past. So that this requires an implementation time and the quality, effectiveness of this circular, which may work well. Ultimately, you reach a position that, okay, all the NBFCs require this. Third, in terms of the restrictions on the group companies, look at the companies who are dealing with the auditors, and if they don't have the chartered accountancy firms, and it's not a matter of the small size firms or the large firms. I think it's for the entire profession. If one auditor is working on one company and he can't work for the entire group, I think it's a loss of experience for the entire group, and they are not in a position to take that experience of that chartered accountant just because in one group an auditor is working with one NBFC or a bank and there is nothing else which he can do. So I think that those are the kind of things which I thought are relevant from the industry's point of view. And so far as the alignment with the Companies Act is concerned, look at what we are trying to and there may be multiple views around this. Companies Act has given a tenure of 5 years and a cool-off period of 5 years. Now, just making variable things like 3 years and 6 years, I'm not sure how we are creating a problem for the industry. So I think these are a couple of items which may be good and bad, but they require a view. So I thought let me clarify that this meeting is not just to raise a question on the joint audit, which is a very minor or a small item so far as this entire NBFC and the banking industry is concerned. There are many other items which may be disruptive at some point in time for the industry as a whole, but a phased implementation with some kind of a transition and rationalization of, let's say, related parties and alignment with the Companies Act, that may be useful. So just 4 points which I said. Back to you, Shobhit.
Thanks, Kaushal. I'll come to you, Mr. Aki, and later. There was one point raised by Sushrit Chitle. Mr. Chitle, you've raised the point that is the presentation made by ASSOCHAM or whether there's a presentation by some firm. So what happened was that Mr. Kishore had reached out to ASSOCHAM to say that, this is an important circular that's come out. It has far-reaching implications. And would it be possible to have this discussion, because it's an important clarification that we must get from the regulator. And that's how this discussion was organized. The idea was that because they had come up and wanted to have this discussion and present, that's why this is not a presentation from ASSOCHAM right now. The idea of this discussion is for the association to get together, to get the views from its members as well as invitees, and then to make a more consolidated, more mature view and take it up to the regulator. So your point taken, and this is the way we're trying to go about, want to clarify as well as to mature the process. There are two points that I would like to just bring up as a question to everyone. One is on the duration. I think the 3-year duration, I don't know what is the empirical evidence that has been used by the regulator or the experience globally to say that instead of the 5x5, we'll take it as a 3-year, because, being an auditor myself, typically of any large institute, irrespective, they might have put a 15,000 crore limit in certain aspects of assets and whatever. It does take at least 12 to 18 months to actually, if you are entering into a new organization, to get a grip of the operations, the systems, the people, the governance, the attitude, the outlook, the principle, and the objectives of the organization, right? Especially in the current world where you have to do so many compliances apart from gauging whether there's a true and fair view on financial statements of the organization. And therefore, to restrict this, because, audit firms typically, if you look at it, I'm sorry, I've been auditor a long time back. I'm sure a lot of you have a better view now of it. But typically in a 5-year period, the first 18 months is really your investment. And therefore, the firm is not really making any money out of it. And then is the stabilization phase. And then if you look at a 5-year window, you realize that, yes, there's some return, because ultimately CA firm also has to make money to be able to grow, to be able to invest time in its research, to create views, etc. So one, I want to debate and ask the question whether 3 years, the rest of the members feel that this is an appropriate action that they've taken, or 5 to suddenly 3 years may be a little aggressive and therefore it needs further deliberation. That's one question that I wanted to throw back or request views from the audience, sorry, for want of a better term. And the second thing that I also just wanted to add here is that, when we are talking about the period of transfer, the transition period, again, if any of the members have a view that they have seen something like this come out in the world, or there are certain circumstances, because at this point of time, the circumstances are absolutely the opposite. You have limited resources, you have limited bandwidth, you're not able to visit people on the site, which has its own permutations and combinations. And a lot of people and a lot of systems are actually dealing with a lot of other challenges. For want of a better thing, I know that, banks are also dealing with the fact that most of their, borrowers are actually going through a much more stressed time as an industry and even as individuals as compared in a normal economic instance. So considering all of these, is the transition period that has been allowed under the regulation good enough or not? So these two questions, please just feel free, whoever wants to add in, but I'll just come back to Mr. Aki. I thank you for your patience and holding on. May I request you wanted to add some views on that, and then I'll come to the next gentleman who had raised a point. Please, over to you. Mr. Rao Aki, you on mute.
Shobhit, by that time we have comments from Divakar, Mr. Swaminathan, and Nilesh.
Hi, good afternoon, everyone. This is Divakar. Should I go ahead? Hello.
Please, Divakar, please.
Okay. So I completely echo to what Mr. Kishore and Shobhit you said, particularly if I want to take a minute and draw a practical example. So we have completed 2 years in the audit of a bank. Now, 21-22 being third year, we will have a joint auditor. And then 22-23, we will rotate out. So again, there will be a new auditor. Then 23-24 will be a year wherein the previous auditor which got appointed in 21-22 will rotate out, and then bank again has to appoint another auditor. So as you rightly said, this 3 years is really a very short of a period. And please imagine the kind of efforts or attention, because appointing auditor is not a small thing or it's an BAU. It does require a lot of deliberations and the skill size, the fit, and more so the criteria which have been laid down. So when a company when a bank tries to fix one tire, the other tire gets punctured in a short time, and then again another tire gets punctured. So this goes on and on. Look at the audit report. Every time there will be para that the numbers of the previous has not been audited by us because we were not the auditors. Now currently I have a big setup of audit because we've never imagined that something of this sort would come immediately in this form. So I have got a lot of skills. I've got the entire department. Now, apart from cooling off and apart from rotating out because of 3 years, I have the fee sharing in the existing client, because now the pie has to be shared. So what I do with the entire resource pool, should I reduce their salary? There are any which is in difficult time. We are in difficult time because we have not raised requested for a fee increase. So these are practical challenges. I mean, I have got a big pool. Where should I utilize them? So I think I agreed to this, and some of the practical challenges we are facing. I would request the commission to take care of that and have a thought on it. Thank you.
Thanks, Mr. Bansal. Kind of you. Mr. Rao Aki was having some problem with the video. Mr. Aki, it's not necessary you come on the video. If you can get in clear audio, please go ahead and make your comment. And I'll come to Mr. Swaminathan Iyer after that. And sorry, before I also owe some minutes to Ayush Tandonji. So Mr. Aki, first you, and then I'll request Mr. Ayush Tandon and then Mr. Swaminathan Iyer to give your comments, please.
Good afternoon, sir. This is Mr. Trimlesh Aki from Andhra Pradesh. During the quality review of audit, what I have attended in the 9 audits, I noticed that out of the 9, total the 6 audits, I noticed that joint audit is not having the documentation. In this scenario, the RBI is noticed that they are giving the rotation period only for 3 years. So if we are unable to get the total documentation during the process of audit, in future any quality review audit is done, is selected by the firm, it may happen they may take the professional negligence on the auditor. So it is better to raise the period as 5 years for the better communication with the company, because NBFC is having the lot of nature of activities, the subsidiaries. Now we are having the company as a group having the 6 type of businesses. Around 145 companies is in the group that NBFC what is having. So at the time of consolidation, we need to understand the total business of the total subsidiaries. Otherwise, in consolidation, we have to unable to review the entire process of the group and unable to document the total of the subsidiaries while giving the audit report on the consolidated financial statements. Hence, it is better to give the period of 5 years instead of 3 years. That is only my opinion, sir. So because of the overcome of the documentation matters, etc. That is only my issue, sir.
Thank you, Mr. Tirumalesha Rawaki. That's point noted. Thank you so much for your comment. Mr. Tandon, please, may I request you? I know you've been patiently waiting. Sorry,
Thank you.
gentlemen, I know it's a difficult task to actually manage, such a well informed audience, but please be patient with me. I'll try and come to all of you. Thank you. Yes, Mr. Tandon.
Thank you, Shobhit. Thank you, Mr. Kishore, for a very crisp and good presentation. And every, all the members that are speaking are making very pertinent points on both sides. On a different note, so there are 2 or 3 limited points that I wanted to make. One is this issue of transitionary provisions. I think this is the critical issue that really needs to go to the attention of the RBI soonest, because right now we are dealing with companies who have auditors who may not qualify under this RBI circular, and they are looking helter skelter on what they are supposed to do, because their Q1 results are supposed to be, the Q1 audits will be starting in due course and so on. So, and then the audit firms also need some sort of clarity, because they also invest when they go for an audit, they are actually investing in manpower. It's not about big firms or small firms. In fact, the smaller firms will be more affected in these transitionary provisions. So I think this is a very critical point which needs to be addressed. The second issue is, being a chartered accountant, the issue of independence. There is the key point that I want to ask Mr. Kishore and Shobhit and the audiences is the RBI going too far now? The issue of independence, the way it started is that when an auditor receives substantial non-audit work, there is a lack of control over what fees is being received, where, on which side, and that's why there is an issue of independence that crops up. So I am all for this particular aspect, that non-audit services have to be curtailed in whatever form. The Companies Act have its own requirements, the Code of Ethics have its own requirements. But now in this RBI circular, what I read is that there is a restriction on doing other audits in the same group, being an auditor. So what I fail to understand is, how is it that doing another audit of the same group entity creates some sort of a conflict of interest? It's as good as doing a big audit. An audit by itself cannot create a conflict of interest for another audit. You might as well, if you are a dishonest person, you can just be a dishonest person. Just because you're doing 2 audits doesn't compromise your ability of independence or anything of that sort. And then apart from this, there were other drafting or interpretational issues that I'm not raising right now, because we are discussing more important issues right now. So I'll just leave it at that.
Thank you. Thank you, Ayush.
Thank you, Ayush. Mr. Swaminathan Iyer, sir, can I request for your comments?
Yes, sir. Good evening. Good evening, sir. Am I audible?
Please.
Yes, loud and clear.
Yeah. I wanted to touch upon certain few basic issues. The Institute of Chartered Accountants of India being the premier body and a self-regulated organization for professionals of accountancy and audit, and also a partners in national building. I think it is best that the RBI leaves it in the hands of the institute to formulate the policies and guide the industry as such, because we have been doing since 1947, right? That is one thing. Because this is similar to a lawyer or a doctor, they have their own SROs. So there is no conflict at all. This is the first point I wanted to make. The second is those who are appointed in 2018 for a period of 4 years. The current year, how they are going to, because once committed by the bank for appointment for 4 years, it stays in things. Can this circular override that appointment letter? Because basically it's a contractual one. I'm talking about the statutory branch auditors. Point number 2. Number 3, the restrictions on non-audit services, I think it has to be removed, because an audit service is different and a non-audit service is different. A non-audit service goes into the angle of a counseling or an advisory service. Thereby, it is very important that the unit as a whole or the auditee as a whole gets a value from the auditor. Number 3. Number 4, the assets they said anything above 15,000 crores. The question is, what is the value of the asset at what point of time they decide? Is it at the time of the beginning of the year or the end of the year or the revalued assets? What is the type of debt? Because the quality of assets is more important determining the quantum. Right. The 5th one, RBI, I see it controls the banks only. It's basically a regulator of banking. And in non-banking, the very word itself, it should not come under an RBI control. It should have been from the, is it that they are trying to take over from Ministry of Corporate Affairs? The next point. Effect by this circular or by this direction, it looks like the RBI decides to take the, supersede the board's role and the audit committee's role in appointment. Does it mean to say that the board and the audit committees are simply a rubber stamp? And are they not answerable to the stakeholders? The last and final one, the discussion with the NBFCs, has it been made by the Reserve Bank before releasing these guidelines? And finally, what is the role of NFRA in case some frauds are found out? Whether RBI is going to take or NFRA is going to take, what sort of things are going to happen? That's all. Thank you very much.
Thank you, Mr. Iyer. I know you've questioned a lot of fundamentals. I would think that in some cases, this is CA Institute will obviously try and put out what their viewpoint, because they're a body of representing the institute of the interest of the chartered accountants. But I would feel, at least this is my viewpoint, that an overarching body like an RBI has the right to put out what the regulation would be, and for the institute to say whether that regulation is right or not. They have the right to comment, like we are commenting on what they have brought out. So I will not. It's not that I'm trying to skirt away from the topic, but I think you've raised a very pertinent point, and I think we'll need more time to debate that. And maybe I'll request Santoshji to just keep that in mind in the next discussion as to the role of the regulator in setting some of these, and whether regulators become overarching in providing regulation in some of the areas, and therefore they restrict in a way, not exactly independence, but restrict the level of ingenuity in some of these changing businesses, which is very, very important as part of the audit. So I'll hold that, but before I can, no one else's hands.
Nilesh's hand is up, please.
Okay, Nilesh, please. Thank you, Kaushik, for pointing that out. Nilesh, please.
Yeah, thanks, Shobhit. Can you hear me?
Yes, Nilesh.
Yeah, thanks. First of all, heartiest compliments to the SOCAM for doing this roundtable. Shobhit, to you and the team, and to Kaushal for a fantastic presentation. Very, very succinctly and nicely brought out the whole thing. To Mr. Narendra, he brought a completely different perspective arising out of his tremendous experience of number of years, heading various banks. And my, respected past president Chikles have also brought in a lot of perspective. I just want to give a couple of more, I would say, add-ons to what has been discussed. First of all, in the case of joint audit, where this presentation should not be there, I think I want to bring out the fact that today the largest company of our country, Reliance, is having joint audit. Birlas have joint audit. Tata still about a decade back had joint audit with A.F. Ferguson and Billy Moore are doing it for decades and decades together. So the concept is, very, very, apart from the fact that private insurance companies, everybody else is doing it, public sector banks, PSUs, and some private other organizations also, apart from what I've named. So I think the saying that joint audit is not, and we need to understand the background from where this is coming from. We have seen a massive failure of ILFS where, I don't know how many $1 billion have been lost or will be lost after the recovery of all the assets. Second is we are seeing DHFL going down under. And forget India, Shobhit, I think we need to understand what's happening internationally, especially in UK, where Carnelian episode has led to the complete revisit of the audit regulation. There is a mandate that by 2024, the firms have to decide whether they want to do consulting or audit. Only one of the two. They can't do both. And there, this discussion of joint audit also had been escalated a lot. not only joint audit, but to the extent that certain category of companies will be done by certain category of firms, large companies by large firms, mid-size and mid-size. I don't know what is the final outcome of that, whether that has been, scuttled. Please pardon my use of the words or whatever. So many interested people interested in a lot of things. So, but that has been a very serious debate which is happening world over. The way governance is being, sort of buried under, I would say, some, conflict of interests arising out of long-standing relationships. I think we need to see the background from where it is coming from, and then decide whether we should represent or not. So, and I gave you, experience. As regards cost, definitely not. The cost will not go up incrementally. It will be completely insignificant to the size of the operations. As was rightly pointed out, it will be just division of the work amongst the audit firms, and very incrementally, some work will be commonly reviewed, the final statements and all, which I don't think will lead to duplication. Again, there is no cost of duplication. Work will be divided, so there'll be no other than, again, very minuscule work. And when we talk of quality, see, I would say the larger thing is whichever failures have happened, whether it's single auditors or joint auditors, where joint auditors have been there. So I would say the fact that no major failures have been pointed out by the joint audits, and most of the failures in India or maybe outside has been single audit, I think that itself should be a good credence, because there is no showcasing what's the benefit. There's no evidence available, there's no studies done. So in that case, I think we need to look at that. Coming to the fact that a firm cannot do an audit for 1 year before or after the group company, I'm fully with Kaushal, with Mr. Chitle and all the other speakers, that the audit of any other group entity requires the same level of independence. There's no conflict. Non-audit service is absolutely a no-no. If somebody is doing consulting, he can't do an audit. I think that let's sort of accept the fact that this is the way the world is moving in that direction. Not only India. And even India, there's a serious discussion happening, not only in RBI, even in the Ministry of Corporate Affairs and elsewhere, they are reviewing that. So I would say what the SOCM can represent is, possibly should not focus so much on non-audit, but should focus on audit, as rightly pointed out Kaushal. If your group auditors and all, they'll definitely be, advantageous for consolidation, a lot of other things. So that I think should be the focus, is my suggestion. I'll leave it to the SOCM how they look at it. Shobhit, you asked a very pointed question on the duration. My suggestion is, I'm fully with you that 3 years is very short. Ideally, it should be 5 years, but one other, I think, midway could be till date. Most of the private banks and foreign banks, there was a 4-year period. Ideally, we should recommend 5 years, but if for some reason 5 years is not possible, it should be 4 years, and maybe a cooling of another 4 or 5 years. That should be one cycle of 4 years or 5 years. That should be good enough, is my suggestion on this particular thing. But excellent debate. Thanks for having this debate, Shobhit, and all the, Kaushal, Mr. Narendra, Mr. Chitle, and all the other participants are there. Thanks very much for the inputs.
Thank you, Nilesh. Thank you so much for that.
Shobhit, if you allow me, half a minute, maybe that I have a few comments on, and they're very valuable comments by everybody, so that it's good to have this deliberation.
Yeah, Kaushal, please.
So Nilesh, thank you very much. I think it's a great experience of dealing with all the 3 items. As I said, I think this debate on this circular in relation to the joint audit is less important from the overall perspective of the circular than anything else. So joint audit is only applicable in this case. As I said, that the PSBs are already done jointly by many auditors, and they're appointed by CAG. And there are not many companies and NBFCs which would have more than 15,000 crores. And even if they are there, I don't think that's an issue in terms of the joint audit. To my mind, if the joint audit can be worked well, if people or the industry can identify joint audits on time for the first and second quarter itself for the listed companies, very well done. I'm sure that it's more for the industry to look at it and be receptive to appoint the joint auditors. No issue with that. I think the discussion went to joint audit more than the other issues. But I think the issues relating to the audits, which are conflict of interest, the audit services to the group, the definition of the group, and alignment with the Companies Act, where 3 years period and 5 years period which can be aligned. I think very important from that point of view, looking at the overall hardship the companies will go through, and identifying the auditors for that purpose, and looking or hunting for the auditors all the time. I think that is more important. Let me reiterate the point again, and then put it to the entire forum. But the comments are very well taken. Thank you.
Thanks, Kaushal. In fact, I just wanted to add, the concept they have now included, obviously, the group and the definition of the group. Now, what it becomes, if I view it from an audit perspective, I'm not taking any sides here, so please, I'd request the audience not to view it that way. Is obviously in the more intermediate or larger firms, you will have situations where they may be auditing any companies which may have international presence as well, where then the concept of ISBA rules, and obviously if the SEC listed some of the larger groups in India, now obviously we've gone a lot to the US to actually list and get money. Now, the definitions of what is to be restricted, not restricted, and I'm telling you now, I don't do audit anymore, but I do more advisory. And even in that, when we are going through the independence requirements, it is a completely such a convoluted mix of requirements between SEC, between ISBA, and now you have definitions being put on by. So the idea of questioning this is not because that, because they are Western regulators, they can put whatever restrictions, and Indian regulators should, really sing to their tunes. My point is that if those regulations are already in place, well accepted by the international community, including us, whatever definitions now come out in terms of restrictions of audit and definitions of a group, somewhere should be harmonized, because it is very, very difficult. The amount of time being spent by accountants and auditors to try and see whether they are independent or not is also a very big question. So if time permitting, this may be taken up as another comment that I would request the members to actually discuss upon, whether the concept of group that has been introduced on this, if you're looking at, like Kaushal raised the point, Tatas or Mahindras or any of these larger companies, if you are there, suppose you are a mid-sized firm and you have the opportunity to audit, let's say, any financial arm of these large groups, does it mean it restricts you from every other thing within the group? I think that's unfair. Then that is not really distribution. That is really restriction. So we need to probably get the RBI to give further clarification on how to really resolve this, and possibly give it more thought as to what they should restrict as in terms of the definition of a group. So just another point. Sridhar, may I ask you to please add in, and then may I also request Mr. Manish Iyer and Sunil Wahal to also put in their comments after this. Sridhar, over to you, please. Thank you for being patient and hearing us out. Sridhar, can you hear us? Your hand is up. Would you like to add in a comment? I'm not sure whether Sridhar is able to hear us.
Shobhit, Nilesh again, just one small comment which I think with the SOK may want to take it up is, as far as the CICs and the group investment companies are concerned, whether RBI wants a joint audit or in fact even a rotation, 3-year rotation, the way they've exempted all the NBFCs below 1,000 crore, just the pure investment companies. I'm not talking of non-deposit taking, non-borrowing companies, just the CICs. That could be looked at in the sense, from a representation perspective.
Absolutely. I think it's a very relevant point.
Sure, Nilesh. Thank you so much for your comment. May I request, Sridhar, can you hear us? Otherwise, I'll pass on. If you can, whenever you get the audio back, maybe you can please, just come in. Mr. Sunil Wahal, Manish Iyer ji, if there's anything that you would like to add, please. Manish, I think you are on mute. I'm not able to make out where Sunil is. 1 second. Okay, any other comments? No further inputs. Anyone's hands up, please just jump into the fray, unmute yourself. Please make us switch up by your comments.
This is Manish Iyer.
Yes, Mr. Iyer.
It has been an excellent discussion, and thank you so much for the invitation.
Pleasure, Mr. Iyer. Please go ahead. Any comments you would like to make?
No, I am very much with all the comments that have been made that the joint audits and all that is not that much important to discuss. What needs to be discussed is that the 3 years rotation is quite short a period in my view. So that needs to be looked into. It's quite a short amount of time because because a new auditor has to come in and understand the systems, and understanding the systems itself takes quite a time. And it is also an investment for the firm. So it's better to better to have 5-year period rather than 3-year period.
Thank you, Mr. Iyer. No, points taken. I think that seems to be a common theme. The idea is not that we recommend that, it should be 4 years or 5 years, but I think when the questionnaire goes up, possibly the idea will be to put it back onto this to actually re-examine whether 3 years will be adequate, because it would be a little longer that would be required. So I think that's a common theme that's coming out of the points and not being questioned. But what is going to be the period, I think, is going to be key. So it will probably be between 4 to 5 years that will probably find common ground between the regulator, the auditor, and the stakeholders who are being audited. So thank you for your comments there. Mr. Hundia, Amit Hundia, I see your hand up. Ayush, your hand is also up unless you did not put it down the first time over. And there is one, sorry, that person's name is not here. There's a number which is appearing. So let's do it in that in that order, please. Mr. Hundia first, if you would like to go, and then Ayush, if you would like to add in, and then I'm sorry, there's a number only. There's no name appearing against that slot. So please. Mr. Amit Hundia, can you hear us? Amit, you put your hand up.
Yeah, good afternoon, Mr. Shobhit. Thank you very much. Thank you to the speaker and yep. Thank you. Hello. Mr. Shobhit.
Yes, we can hear you. There was some disruption, but we can hear you. Amit, you'll have to be a little louder, please, if you can.
Yeah. Yeah, sure. So thank you very much once again to the panel and the speaker and all the learned members for sharing their knowledge. It's a very good deliberation on the new regulations which we had. Hello. Hello. I think so there is a lot of disruption. Hello.
No, Amit, we can hear you loud and clear. Just go ahead.
Am I audible?
Please. Yes, you are audible. Please go ahead.
Yeah. So, Mr. Shobhit, I have a small question. I mean, I know there's not forum to discuss the question. But for example, this 1 year before criteria, like before you are appointed as an auditor, one cannot be, one should not be doing audit, any non-audit work or any other activity before 1 year of appointment. Now the question is, like this had come just now on 27th of April. So should we say that this will be applicable in prospective effect in future periods, or it should be said that with retrospective effect? For example, if there's a CA firm which was doing some kind of advisory or consultation earlier, now this regulation comes up. So this was not known earlier. And in the law, it is always known that unless and until specified, the regulations are always prospective in effect. But here the provisions are totally silent. And the second question, whether here this 1 year provision should be considered from the date of appointment or from the beginning of the financial year. So for example, if the appointment happens on 27th of August in AGM, then on 27th of August 2021, prior to that 1 year should be considered, or like this financial year 1st April 21, prior to that financial year should be considered. I mean, reading into the language, it appears from the before the date of appointment. So not before the date of the financial year. So I have these two questions.
No, good questions, Amit. And typically, at least whenever I've seen any regulation come out, both in nationally or internationally, these clarifications or FAQs are typically brought out as part of the transitionary provisions. to say what do you define as 1 year,
Yes.
when will it be applicable, from when it will be applicable, what are the do's and don'ts. So maybe I'll just request if Kaushal has been able to study or get any answers or deliberations based on the earlier discussion they've had, and anyone else that might want to add into your two questions. Kaushal, may I request you?
Let me give a very brief answer to this. I think both the questions are very relevant, and that is the challenge we've discussed and thrown to the industry also, because both are unclear at this point in time. If we need to apply it, and as you rightly pointed out, that an audit firm was appointed last year, they didn't know what kind of provisions can happen. If I apply it retrospectively, firm may become ineligible to be appointed. So this is a clarification which we are also looking at, and I'm sure that during the presentation you must have noticed that we are also looking at that part. The second is that the clarification as to the period. We should be independent. Let's say the language of the circular is not very clear. What it says is 1 year before or after the appointment. So unfortunately, it's not talking about the financial year. So one may take a very literal interpretation that you were appointed in August, and 1 year before you've done, that is from the date of appointment. And you can take it that when you got out of the audit 1 year after from that date, that is a possibility. So I think that is the only thing which is available today, but it requires certainly a clarification from the RBI that they mean the financial year, or when they're talking about only the date of appointment and date of resignation, or the exit from that date you count it. So it's a matter of clarification for us as well. In the previous circular for such services, this was again the date of exit. It was not the financial year from that exit. So one can clearly say that okay, it should be taken from the date of exit. Mr. Chitle had a comment on this.
Yeah, I think quickly on both these points. See, if you look at the audit and non-audit surveys, actually the concept must have been taken from section 144 of the Companies Act. And therefore, if you look at para 6.4 of the circular, where it refers to audit stroke non-audit surveys, actually what is possibly intended is that word audit should have been internal audit. I think in case that is the clarification which comes, the whole matter becomes very, very clear, because 144 also permits by and large. Of course, on that also there are professional views differently, but normally in a group, if you're doing statutory audit, you should be all along doing statutory audit. If you're doing internal, you should be all along doing internal. I think that's the concept which is broadly prevailing amongst the professionals. Same principle to be imbibed into the circular, I think would be the right way, first point. And secondly, I think well, logically, this period of 1 year would relate to financial year with respect, I believe, because end of the day, we are audited a particular accounting period that is financial year. Of course, a clarification would be better, but I would relate it to a period of financial year and not the date of appointment, etc. But that's my interpretation. Thank you.
Mr. Chidle, I mean, well made, points well made, because that's a clarity which is certainly required. And if one counts the financial year, it goes beyond 5 years also. So that also is true. But certainly either way, whatever we need to apply and the RBI intends to apply, they should clarify it, and there is nothing else actually. Whatever they say should be made applicable. And even on the point you made on the audit and internal audit, I think it's a very valid point, because if you look at the 2006-7 circular of the RBI on the internal assignments and the special assignment, they specifically talk about the internal audits. You are absolutely right. But unfortunately, the way language has been worded in the circular, that has created a lot of confusion, and it certainly requires a clarity. Otherwise, we don't know what is the intention of the RBI at this point in time.
Thanks, Kaushal. Thank you, Mr. Chitle. Ayush, may I request you to, your hand is up, so may I request you to briefly make the point, because Lalit is also there he's also got his hand raised, and we'll just be running out of time. It's another 4 or 5 minutes that the call is on for.
Very quickly, one clarification that I thought we should obtain if this goes further. So there is, in these provisions, there's a cap of maximum audits. So 4 bank audits and 8 NBFCs. Now within NBFCs, there are 2 categories. Whether you are above 1,000, then you are automatically covered. Below 1,000, you have an option whether to be in the circular or not. But where they've prescribed the cap, they just say 4 banks and 8 NBFCs, without specifying whether the smaller NBFCs will also be covered in this cap of 8 or not. So that is if it is covered, then basically it's quite a restriction for the audit firms, because they may have a lot of NBFCs which are either non-operational or which have a very small turnover and so on. So this clarification should come from the RBI. Thanks.
Especially in light of the fact that earlier there was no restriction on the number of NBFCs that were to be taken.
Right.
Absolutely. No, thanks for that. Lalit, may I just jump across to you? Would you like to add in your points, please?
Yeah, sure. Shobhit, thank you so much. Thank you, Kaushal, for making that presentation. I think most of the things have been covered very well in the discussion. A couple of points which I thought specifically, I think tenure, 5 years minimum should be what we should consider. Retrospective implementation. So where, a firm is doing some audits of NBFCs, only 2 years have passed, but the total number of audits is say 10, 12 or 15 NBFCs, right? You may immediately be required to resign because you are already doing more than 8 audits, right? How do you address the concerns of the clients, suddenly leaving them in the lurch of wanting. So one prospective application of the guidelines, which means that when you complete 5 years, then you exit and then start counting maybe 8 NBFCs or whatever. So this basically to cover industry. The other point which Mr. Chitle, I think, covered on the independence, right? 1 year prior and 1 year after. So if we look at the regulations across the world, including the code of ethics that has been set up, the idea is, and SEC does that, right? I mean, if you are getting appointed as an auditor of a company and you have done any non-audit service in the past 1 year, which you would not have done if you were the auditor, then possibly you are disqualified, right? So the intent of look back period is 1 year, but you should not have done anything that you could not do as auditor is what we should look at. So if you have done an audit, it should be perfectly fine. If you have done a service that is permissible under the code of ethics or the rules, that should be fine. One thing that I think, again, we should consider is removing the requirement to render any service after you have ceased to be the auditor. So if I have ceased to be an auditor of an NBFC or a bank, that limit may be considered. It should not be prohibited to render any non-audit service, because I think if one looks at the genesis, why somebody would say that, right? To me, it appears it's questioning the integrity of the profession as such, right? I've done my opinion, I have issued an audit report, and why would a job later on, I have completed my tenure, why would a job later on have a bearing on the current work that I'm doing, right? So I think somewhere as a professional, I feel this restriction should not be there. Prior to appointment, 1 year, that too for services which an auditor could not have done is what we should consider. So that's all I have to. One last thing, I think we've talked about joint audits and quality of work, and it's my opinion and belief that audit quality is linked to the fundamental principles that are established for the profession. Now, when those fundamental principles are delivered by a single auditor or 2 auditors jointly or 3 auditors jointly, it does not matter. Quality is upholding those principles, right? So whether it's a joint audit or not a joint audit, quality is untouched so long as all those principles are upheld. So let's not link joint audit with the quality of the work. That's it. Thank you so much.
No, thank you, Lalit. Thank you for your comments. I have a viewpoint on 2 points at least that you mentioned, but Kaushal, you also have your hand up, please.
No, I'm done. Actually, I was just, I did not put it down. Thank you.
Okay. So, Lalit, in terms of the quality issue that you were saying, my point of view there is that the quality is it's an underlying principle. There is no two ways. Quality of audit has to be, that's the fiduciary duty that is placed upon the auditor on behalf of the society, on behalf of the community as a whole. The only challenge is that these are manifestations of how you're trying to manage the quality, right? Because a single auditor, because he's like Mr. Narendra said right at the beginning, that is the firm, does it have the large enough resources, or does the firm have the resources to make sure that all areas are audited to the standard that may be required, and therefore you actually hold to. So while I think we are just talking very similar things, maybe just a little different facet, but consistency in terms of that quality has to be ahead. My only point was that empirically, have you found as the subject of the audit, have you found the single auditor or joint auditor is more effective? If your practical experience is that joint auditors do add more value, then that's what really matters to me, nothing else. That was my only point there.
Yeah.
And the second point that you mentioned about 1 year and only the auditable, if you were providing services which you ordinarily would not have provided if you were to audit. Actually, Lalit, there are just so many viewpoints that I've seen from a regulator also. I don't know, you may be more correct. My understanding is that SEC, audit committees put their own restrictions in large corporations. So there are various combinations, like it could be that at the time of the audit proposal, you should be independent, right? Some restrict for a full year. Some say, and after a year, the only reason is, I think what might be playing on the minds is that as an auditor, you have a lot of insights which ordinarily others will not have. And therefore, you put a 1 year cooling period to say you may not be required to provide advisory services, because you could be knowing a lot of things which you immediately can use for the purposes of your advisory. Excuse me. So that was the only comment I had. But your point is there, that once I've signed off, why are you unnecessarily restricting me? So I think it requires a little more debate, and it's not as easy to just say blanket 1 year ban. You shouldn't be allowed to do. So pertinent points.
I think,
thank you for raising
one point, Shobit, sorry to Bajin like this. The one point which I believe RBI had a thinking was that since they are restricting the tenure to 3 years, it should not happen in different ways. We continue to remain in a similar position. I'm not saying the same position, but it's a similar position in either in the company or in many other companies. So I think that may be the thinking, but maybe it's a drafting issue, that whether it is regarding the audit and non-audit services or with the group, the intention has to come out through a clarification, FAQ, or some kind of a change in the circular. To my mind, that's how I would look at it.
No, absolutely. I think that is very much required, and a lot of questions where, gladly, a lot of areas where I think there's unison in the opinion that a lot more clarity is required. There needs to be some more deliberation within the regulator in consultation with the rest of the stakeholders. And in some, I guess, there will always be divergent views. So, gentlemen, firstly, thank you so much. I know this is not an easy period, and we really appreciate the fact that, we were almost 125 people at one time listening in, which is a fantastic effort. And thank you, Santoshji, despite not being too well. I know I'm not too well. In fact, not being well, you've actually been able to do it with the team. So thank you for your team. I'd also special thanks to Mr. Narendra for, his initial comments after Kaushal's presentation. Actually, I wouldn't say it stirred a hornet's nest, but I think it was very close to that. The amount of participation that I've seen has been far more than what I've seen in a lot of other roundtables. I think this is an important topic. The banks hold everyone's money, and it is a very important fiduciary duty that the regulators are doing in terms of ensuring both the independence of auditors, that they are objective, and also that they do it in the manner that it should be done. So unless anyone else has a very, very quick comment, because I know we have overrun the time, I'd like to conclude. Santoshji, if there's anything else from your side, please add in. But again, a heartfelt thank you to all of you, and also a thank you to Kaushal for spending the time, investing the time, and taking this on to really present to us and take us through the overview of what have been the changes and what could be the pertinent questions that need to be deliberated in further detail with the regulator.
Thank you so much.
Thank you, sir.
Right. So unless I think we can, we already over time. So
everybody should take a lot of care now. That is important, along with the subject. Santosh also.
Yeah, thank you so much, sir.
Yeah, but हमारा health issue to link this COVID has to be taken.
Thank you so much, sir.
Thank you,
Thank
Mr.
you so
Naik.
much, and thank you,
Thank you, Mr.
Kaushal sir, for your making this comprehensive presentation on our request basis. And
Thank
we
you,
are
sir.
thankful to entire all the participants or those who have contributed. We look forward to many more such comments as we can, and also
Thank you.
request
Thank
all
you.
to please submit your views further in editable version in Word file on our email ID, which you already have received some communication, santosh.parashar@asochem.com, and we would look forward to your valuable comments to be incorporated in our representation, and then we'll come back. Thank you so much.
Thank you, Mr. Chitle. Thank you, Ayush. Thank you, Nitish, Manish, Mr. Aki, rest of the speakers, and thank you for your contributions.
Thank you.
And all the best. Stay safe.
Thanks.
Thanks, everybody.
Thank you.
Take care. Bye.
Thank you.